Stocks trade soft and ranged above a critical support zone, keeping the street on edge. Utilities and capital goods eke out gains, while healthcare and realty drift lower.
JLR plans to invest about £15 billion on electric vehicles over the next 5 years and launch 3 EVs in the next 2 years itself. The big spend pushes its cash break-even down a year to FY25, but analysts keep the faith.
Experts tell CNBC-TV18 that any move to phase out FAME subsidies by end of FY24 could significantly stunt growth of the electric vehicle sector, with EV-only players set to bear the biggest brunt.
Mastek jumps on a strong performance after Infosys debacle, where ICICI Securities puts up a weak show, unlike Angel One.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Sonia Shenoy as well as Mangalam Malu. Well, it's turning out to be a session where at least we have broken that 3-day losing streak rather for the markets. So currently we have all of the indices which are trading in the green. We have the Nifty, which is higher by just about 7 points. And what has taken place is that mid-cap as well as the Bank Nifty outperformance, which we've seen all these past couple of trading sessions, has resumed. If you look at it on a month-to-date basis, the Nifty is higher by a little over 1%. And all this while, we've seen the mid-caps, in fact, outperform with a gain of around 4% The small-cap index on a month-to-date basis has gained around 5%. And similar case with the financials. As you can see, the Nifty Bank is up around 4%. Nifty PSUs are up around 5.6%. We have a lot in terms of earnings coming out within the banking space in the next couple of days. So that will be an important cue for the financials. But as of today, an outperformance.
Outperformance indeed, but we never know whether it closes below the red line or above it, because it's just meandering around the red line. And increasingly at 12 p.m., it's getting more and more comatose to speak about the way the market has been.
We're just trying to excite a dull market.
Let's excite the dull market. Then we talk about the Bank Nifty. It's up 120 points. At the same time, the mid-cap index, which was underperforming yesterday, is outperforming today with a gain of 1/3%. We have nearly 3 stocks advancing for 2 declining. A bunch of stocks doing extremely well from the broader markets, all of them up around 10, 11, 12%. Case in point, something like Mastek, it's undoing some of the IT underperformance over the last few days. Exciting enough?
I don't know if that's exciting enough for you, but it's definitely not exciting enough for me. But, we had the same issue during Bazaar. We were trying to figure out which are the stocks that are moving, right? And then we caught hold of names like Sula Vineyards, Som Distilleries. So where the real excitement lies, right? All of those stocks are up.
You're just upset that there's no long weekend this week. This is the first time we have 5 trading sessions, I think, after 3 to 4 weeks.
After 3 to 4 weeks. But the good part is that next week has one long weekend because we have 29th, 30th.
But that's Monday.
30th, 31st. Yeah, that's even better. No Monday morning blues.
Absolutely. All right. So we're making it exciting for ourselves, despite the market being really, slow today. But there are plenty of stocks that are bucking the trend. Mastek is one stock. It's up over 12% on the back of a very strong performance in Q4. Rima is here to give us the earnings fine print. Rima, what went so damn right for the stock?
Well, it's just a strong performance all round. Very good execution. The company has been winning order wins, and their key market of UK and Europe is firing for them. So let me run you through the big numbers. A constant currency revenue growth of more than 5% quarter on quarter. Year on year, it's almost a 20% growth. And the quarter on quarter numbers are pure organic. Right? So it's more than a 5% organic revenue growth. And compare this with expectations. Sharekhan, for instance, was penciling in a 1.8% revenue growth. So compared to street expectations, these numbers have blown the lights off. Margins too have improved by 50 basis points to 17.8%. UK and Europe, that's the key geography for Mastek, contribute 60% to the overall revenues, and that's seen a growth of more than 10% quarter on quarter. The order book has picked up sequentially by more than 5%. The cash on the books is 270 crore rupees, and the attrition is trending down at 21%. The management commentary in the conference call was also upbeat. They are planning to, the aspiration is to grow their margins to high teens. They've ended FY23 with margins of 17.8%, but when they mean by high teens and what their aspiration is, I think they're trying to get closer to that 18 to 19% band. They also said that they're quite confident about growing faster than the industry. So good Q4, and even the outlook by the company in terms of margins and revenues appears to be very promising, so that macro uncertainty, at least for now, doesn't appear to be impacting Mastek in terms of pure execution and delivery. Back to you.
All right, Rima, thanks a lot for that. So that's about Mastech. In an otherwise weak environment for the IT stocks, some outperformance, and we see a big move on the stock, up around 14% as we speak. Another stock on our radar on the back of their numbers is Tata Communications, and this after a margin miss in the fourth quarter. But the MD and CEO of the company, Amur Lakshmi Narayanan, says that they're comfortable with their current net debt to EBITDA levels and speaks about the prospects of the business. The street likes that, and as a result of which, despite the miss in the margins, the stock doing well today.
I think barring one market for us internationally, all the markets have been firing in all cylinders, if I may say so, all posting in excess of 15-16% growth. If you look at our Asia Pac market or our European market, they have been growing at high teens. We appeal to both the cost side of the equation and the revenue side of the equation for our customers with our enhanced products. We would like to think for the next 2 years, customers are going to focus more on cost-led transformations that also delivers better experience for their customers. And if you look at last 3 years, and you pointed that out, our debt has come down quite significantly. We are quite comfortable in terms of our net debt to EBITDA ratio. We have a strategy of a good cash generation within the company, and our first priority is to invest back into our products and platforms as we've been doing in the last year and going forward as well. But anything excess, we are going to be looking at debt reduction as a priority. We also just announced, for example, an M&A transaction with a company called Switch, which we hope to conclude soon.
Okay, so that's Tata Communication, but let's focus on another stock which is underperforming today. It's down around 3.5% ICICI Securities, which has slipped after reporting what was a weak set of numbers in the fourth quarter. Surbhi's with us to decode the numbers. Surbhi, over to you.
Thanks so much for that. So it was a weak set from ICICI Securities, but this was on expected lines as they were losing market share in their active client base for the last 10 months. Also, their trading volumes were lower on a year-on-year basis. On a sequential basis, their revenue was flat at 885 crores. Both their PBT and PAT were down 7%, mainly due to higher operating expenses and higher finance costs. When you look at their segmental data, their broking revenue was marginally higher by 4%. This was due to increase in retail derivative volumes. Their profitability was, however, lower by 3%. The issuer services segment, that has dragged down the revenues. There, the revenues were down about 74%, mainly due to decline in primary market activity, and the profitability was down 90% on a sequential basis. Now, we have two opposing views from brokerages. Citi has a sell rating with a target price of 440. They say that given in the volatility in the capital markets, the cost pressures are key monitorable. Also, they do appreciate the company's focus on diversifying its revenue profile, but the investment in these businesses is too high. The only silver lining, according to them, is the traction in distribution and wealth business. Motilal Oswal, on the other hand, has a buy rating on the stock with a target price of 530. They say their efforts to diversify their revenue and launch of new products will only enhance their revenue going forward. Company will continue to invest in human resources and technology, which could lead to a lower cost to income ratio in the future. They value the company at 12 times FY25 PE.
Okay, thanks a lot, Surbhi, for that. Well, let's get you some more stocks that are moving on the back of brokerage commentary. Paytm is the one that's gaining in trade. Motilal Oswal initiated coverage on the stock, and the stock is now up almost 2.5%. Abhishek is here to give us more details. Abhishek, over to you.
Well, Sonia, as you mentioned, Motilal Oswal has initiated coverage on Paytm, a buy recommendation and a target price of 865 per share. The key headline of the report is Get Set Pay. So they say that there is two-pronged strategy to drive the profitability of Paytm, and they expect EBITDA to break even in FY25 for the whole year. So Paytm's business posting healthy growth rate right now, and they estimate 21% CAGR in revenue between FY23 to FY25. They estimate disbursals to report a steady 64% CAGR between FY23 to 25, and thus that will drive the mix of financial revenue upwards to about 31% by FY25. They estimate contribution margin to improve to 56.8% in FY25 from the levels of 30% that they had reported in FY22. So this will be fueled by improvement in operating leverage as well as rise in financial business in the overall mix. So Paytm has achieved a break even in adjusted EBITDA in Q3 FY23, well ahead of the guidance is what is stated in the report. And they say that, they estimate Paytm to achieve an overall EBITDA break even by FY25. And that is why the stock has gained in trade today. Back to you.
All right, Abhishek, thanks a lot for that. So that's about Paytm. But Motilal Oswal has generally been bullish on a couple of these new age companies. A couple of days ago, we saw them initiating coverage on Zomato as well with a target price of 70 odd rupees. And all of this ties in with the fact that central banks around the world, RBI starting, have paused interest rate hikes. And as that happens, these new age companies and companies with high PE multiples come to the fore. But talking about some ideas that we're looking around today for stocks that are moving, VIP Industries is one of those stocks which are buzzing in trade today. And this is our special segment, Value Add. If you just take a look at the last 12 months, the two listed luggage players in the country that we have, VIP Industries has actually fallen about 16%, the share price that is. And that of Safari Industries is up 130%. So that's a massive outperformance that Safari has had over VIP. And Anand Rathi this morning has initiated coverage on the luggage sector, saying that the organized players would see a growth of 15% in the industry over the next 3 to 5 years. So this underperformance of VIP Industries, Anand Rathi believes, should actually, come undone, and they will catch up and will offer better returns than Safari going forward. Why is that? Because they have 4 growth triggers. One, they have a renewed focus on the mass category, a category in which Safari has been gaining market share slowly. Secondly, VIP Industries has also targeted doubling of its international business, so another source of revenue coming in from the company. Further growth from their premium brand Caprese is something that the street is eyeing. And finally, VIP Industries also looking at self-sufficiency and reduction of dependence on China. So these factors should help them going forward. And over and above everything else, what it has done is this underperformance has made VIP a lot more favorable when it comes to valuations as against Safari Industries as well. VIP Industries trading at 30 times one-year forward earnings as against Safari, which is 35 times. So, which explains why VIP is outperforming.
Okay, all right. Maybe there is a lot of luggage buying ahead of the summer.
I'm just thinking about all the travel, right?
Yeah.
That's coming up for all of us. Go get your luggage and then take that next
A lot
flight
of
out.
kids having their summer vacations and all that, so
Exactly.
families do travel, and before travel, people perhaps buy their luggage.
Maybe renewal after, renewing your luggage after COVID-19, all of that. But nonetheless, a lot of pent-up demand also. Maybe need to take a short break. We'll get you more on the markets and put the focus on the pharmaceutical sector, which has been outperforming.
All right, welcome back to Halftime Report. The market may be quiet, but we are not, because there are plenty of stocks that are buzzing around. So we're here to tell you about that. Cummins is a stock on our radar. There's a bull and a bear case. Kotak Institutional Equities has a buy call on the stock, while BofA Securities is in the bear camp and they have an underperformed rating. Nimesh is here to tell us more. Nimesh, today looks like the bulls have it. I mean, the stock is up 3.5%. But tell us both the scenarios.
Well, Sonia, this is what market is made about, right? There is a buy and a sell. For every buy, there is a sell. And for every sell, there is a buy. So, Cummins fits into a classic bull versus bear case. Last week we highlighted in my standard as well that there is a downgrade from BofA. But before that, let me highlight the bull case today, which has come from Kotak Securities. Now, they have a buy rating on the stock, target was of 1810. And for them, Cummins is the top pick in the capital goods space. Now, Kotak believes that the company is structurally well placed. And the recent announcement by the parent to invest $1 billion in the US unit argues that there will be a case for outsourcing to the Indian company, which is Cummins India. Not only that, the margin gap versus the peers do suggest that Cummins has got a business high on scale, localization, as well as they are gaining market share in the high margin business. All this argues well in the medium term. That's according to the Kotak note. Now, Kotak has written the estimates and they're building in a 16.5% revenue CAGR between FY23 and FY25, and they're building in 18% of margins and close to 26% of ROE by FY25. So that's the Kotak note, and they argue for as a bull case as far as Cummins is concerned. Remember, last week I had highlighted the downgrade from BofA Securities. They've downgraded the stock to underperform from buy, and they had a target, and there they cut the target first to 1434 on Cummins. Now, there are 4 key reasons BofA had highlighted on why they downgraded the stock. One, of course, they believe that the 50% price hike which is going to come in the CPCB 4 norms, that could hurt the volumes going forward, and that will be visible from Q1 of FY24. So that was the first reason. Second, they expect that FY24 and FY25 EPS growth of 15% and 17% do price in the pre-buys, and hence at these valuations the upside is limited. Third, they believe that the exports, which contributes nearly 1/3 of the sales, that's going to disappoint on the back of global slowdown. And fourth, BofA believes that most of the margin expansion of 560 basis points is pretty much in the price, and going forward there could be challenges. So while BofA downgraded the stock today on the back of Kotak note, you're seeing a bit of a recovery as well. So a classic bull versus bear as far as Cummins is concerned.
Okay, all right, Nimesh, thanks very much for that. So that's a bull and bear on Cummins India. But I'm watching the entire pharmaceutical space, and 3 stocks which stood out and which saw a rally in yesterday's trading session, which was Piramal Pharma, Divis Labs, as well as Gland. Now, one of the key points which the street could probably be considering is a Q-on-Q recovery, which could be possibly in store for a couple of these stocks. Now, I'll just tell you about what happened in Q3 to get a better idea about it. So Piramal Pharma, for example, had their margins fall all the way to around 5.1% versus 10% on a Q-on-Q basis. There was a worsening which took place on a year-on-year basis as well. And they had incurred a loss of around 90.2 crores versus 37.3 crores in terms of a loss on a sequential basis. So there was an expansion in terms of the losses as well. Divis Labs, that was one of the worst margins that they've reported all the way, I think, since FY12. So margins had dipped all the way to around 23.9% versus, as you can see, the trajectory and over 40% margins in the same time last year. Similar case for Gland Pharma, where the revenue was down 12% last quarter. Margins were okay, 30.9%, but the profit was down 15%. So what the street is probably anticipating is that there could be a recovery which could be taking place in a couple of these counters in terms of earnings and what they report in Q4. Just to put it into perspective, these stocks have risen from their 52-week lows. So Divis Labs, Piramal, Gland Pharma, all of them have risen anywhere between 20 to 24, 27%, but they're still significantly away from their 52-week highs, as you can see on the screen. Remember, Piramal Pharma, for example, listed at 200 rupees in October of last year, and since then it had seen levels of almost around 68 odd rupees. Since then it's been a recovery, but nonetheless down 4.6% today. The larger picture is maybe a Q-on-Q recovery for these companies. But earlier today, we did speak to Param Desai, who is the research analyst at Prabhudas Leeladhar. He was making a similar point for Divis Labs. He mentioned that Q3 margins had dropped for Divis, and maybe there could be some recovery. Listen in.
Q3 Divis result had taken a sharp hit on the margin side, largely due to the lower margin contribution from their CDMO business, and also due to the high raw material price inflation. In our assessment, the margin, gross margins, what Divis have reported around 56-50, that was the lowest since FY12. We would not extrapolate to that, as some of the things have started easing down, and specifically on the raw material side. So the benefit of that will be start getting visible from the Q4. So we do believe that there will be sequential improvement in the names like Divis. Along with that, they are coming up with a high COVID base. So now I think the last 2 quarters also, I think the numbers are largely reflect their base business, and they have a reasonably good pipeline on the CDMO as well as on the generic API side. So there will be a sequential improvement in the names like Divis from here on.
All right, so that's about the pharmaceutical space, but I'm just looking at Divis, rather Liberty Shoes, and the reason why I'm looking at Liberty Shoes is because it's an unusual mover today. The reason why I say that is because, today it's up 16%, no news backing that. In fact, this month itself, the stock is up around 32 odd percent, and it's been prone to these unusual moves. If you just take a look at the one year chart of the stock, it's moved around 58% in the last 1 year, last 12 months that is. But from the 52-week high, it's also corrected about 42%. And multiple times over the last 15, 16 years, we've seen the stock see a big move of almost 1.5 times, 2 times, 3 times. And then over a period of few months, it gradually goes back, halves from the peak that it hits. So no fundamental reason backing this movement, which is why it qualifies to be an unusual mover. That's Liberty Shoes up 16%, up 32% this month.
Okay, people are buying luggage and they need shoes perhaps to travel as well. So more shoes are being bought.
Perhaps, but I'm not sure whether people who are buying VIP luggage are the same people who are buying Liberty shoes or not.
Obviously. Well, Titan is definitely, seeing a lot of buying action. There's the festive period of Akshaya Tritiya. People generally go ahead and buy gold at that time. Do you think that could be spurring the Titan stock?
Yeah, that is one of the bigger reasons that is spurring the Titan stock today. It's holding up in the green by about almost 1%. But the other reason is that we understand that Tanishq has gone ahead and reinstated its advanced booking option. And this advanced booking option basically allows buyers to lock in the price of gold ahead of Akshaya Tritiya. And that's the biggest thing, right? Because for people who do buy gold on auspicious occasions like Akshaya Tritiya, which is on this Saturday itself, the biggest fear is the price that they will pay for the gold that they buy on that day itself. So what you do is you lock in your price today and say that I will take the delivery on Akshaya Tritiya, which helps buyers, support them as far as the price is concerned for the near future. And at the same time, it spurs demand for Titan as well. So those are a couple of factors that why Titan is doing well. Apart from that, yesterday we had the news of them reducing the commissions that they are giving to dealers. So that would be margin accretive for them. And CLSA has ascribed a valuation of $2 billion, roughly $2 billion to their eyewear business. So that is another thing that is working for Titan. But the near-term uncertainty of demand with regards to higher gold prices continues to remain.
As a consumer, I would definitely, vouch for something like that, considering the volatility or the increase that we could see in gold prices. So not from a stock perspective, but entirely from a consumer perspective.
Yes, but then there's also the risk, right? For instance, if you lock your price today at 62,000 or thereabouts, and by Akshaya Tritiya it falls to 58,000, then you've locked your price. And it works the other way as well.
Yeah. Okay, high risk, high reward perhaps.
High risk, high reward.
Let's slip into a quick break on that note. On the other side, Ruchit Jain of 5paisa.com will join in with some trading strategies, and of course we'll keep talking about the markets as well. Stay tuned.
Welcome back. You're watching us here on Halftime Report. The market's virtually unmoved at midday right now. The Nifty just at the flat line. There we have it. 17,619 is where it closed yesterday. 17,620 is where we are right now. And this is perfect markets for people to, go ahead and write options on both sides, both calls as well as puts, when they play for the range. And that's important mainly because it's also weekly options expiry today. The important part, however, for the market is that the low on the Nifty today was 17,590. And that compares with the 200-day moving average of 17,587. So that's, one test of that 200-day moving average in today's trading session. And that's telling you that we will find support at those levels. But because it's weekly options expiry and we see a lot of option writers being active, the option writers today are active at 17,650 call and 17,650 put. The premium on this 17,650 call plus put, which is known as a straddle, was about 50 rupees yesterday, telling you that the street is working with a 17,600 to sort of 17,700 sort of range. And today it's close to around 60 rupees as well. So the street is playing for that 17,590 to 17,710 range. On the way up, 17,700 call continues to see some writing as well. So it's telling you that levels closer to 17,700 will continue to face some resistance. And that's what was witnessed in today's trading session as well. The high on the Nifty was closer to 17,700. 17,684 was the high. The three things we have to watch out for, and that can move the market either way. One is the mid-cap index. The broader market's outperforming today. Secondly, the Nifty Bank, which also is outperforming today and is a little more resilient than Nifty. And the third thing we're watching out for is the IT pack, mainly because if it's underperformed for the last few sessions, ever since TCS's numbers have come by, but Mastech's numbers have caused them to at least not fall much. So if the IT index finds its bottom, we have HCL Tech's results post-markets today, then maybe we could see some support on the Nifty and some momentum on the upside.
Okay, thanks a lot for that. So that's in the F&O space, but let's also get Ruchit Jain of 5paisa.com to tell you about the market momentum. Ruchit, first on the IT sector, right? I mean, we've seen a sort of fall off a cliff situation for many of these IT names, but as Mangalam was also pointing out, after Mastech's numbers, looks like maybe the selling pressure could get arrested. But what are the charts showing you in terms of all the large cap names, the TCSs and Infosys of the world?
Yeah, hi, very good afternoon to both of you. If I start with the Nifty IT index itself, then the last time when the markets had corrected in September 2022, the Nifty index, IT index had formed a low around 26,200, from where the pullback move towards 31,500 was seen. And that's the exact low which has been formed on the day of Infosys results, where 26,200, 180 was the swing low. So I think that if till it continues to hold on, I think the downside seems to be very limited in the IT stocks from here on. But if one is looking from a trading strategy, looking at this index, then I think one should be very selective. So rather than looking at those stocks which have seen short formations or which have shown a very sharp correction, I think my preferred thing would be to look at the outperformance which are not falling in this corrective phase. For example, take a look at Coforge. Mastech today we have seen a breakout. Then Coforge is one of the F&O stocks which has not fallen significantly along with the IT stocks in last 3 or 4 trading sessions. So I think one should look for such outperformance in case if one wants to do any kind of bottom fishing in the IT names. But yes, the underperformers which are there, one should avoid any kind of bottom fishing there.
Okay. All right, Ruchit. Thanks very much for that. So that's on specific stocks. But what is your recommendation today?
Yeah, so I have a couple of buy recommendations since the broader markets have been doing well. Trend is my first buy call where we can clearly see a consolidation breakout. If you look at the March and the April month, since the second half of March, we have seen some consolidation which just seems to be a time-wise correction within an uptrend, and today there are signs of a breakout from the time-wise corrective phase. So one can go along on trend with stop loss below 1354, expecting target somewhere around 1450 in the short term. And Voltas would be the another stock where we are expecting some pullback move. Primarily, if you look at the F&O data, the recent correction from the swing highs have not seen any kind of short formations in Voltas. And now when we have witnessing some pullback moves, gradual long formations have been happening in Voltas. So I think the downside has been done with. So a pullback move at least towards 900 can be expected from here on. You can see the entire sector, other stocks from this sector such as Havels are also witnessing rise in the volumes along with the price up move. So Voltas could be bought with stop below 836 for target around 900.
All right, Ruchit, thanks a lot for joining in and giving us your views. Voltas at the high point of trade, just as the temperature is at this hour as well. Take a short break, come back. We will get into a conversation with Rajiv Juneja, who's the VC and MD of Mankind Pharma ahead of its IPO.
Welcome back to Halftime Report. Now, homegrown, domestic-focused pharma and consumer health company Mankind Pharma is hitting the market with a pure offer for sale worth 4,000 crore rupees next week. Rajiv Juneja, the Vice Chairman and Managing Director of Mankind Pharma, the company which is a manufacturer of brands such as Manforce, Prega News and Unwanted 72, talk about the interest seen in the roadshow to the growth drivers as well as margin pressures. Listen into what he had to say.
We traveled 45 days, met every possible big foreign institute, domestic mutual funds, insurance people. So everywhere, they have really, welcomed us very, very warmly, and hope you people will also do the same thing.
In terms of your business, 97% sales come from the domestic market. Exports is just about 3 to 4%. You don't have much of a presence in, a mother market like the US. Is that going to be the growth trajectory going forward, domestic markets and a little presence in in other markets such as the US?
Right from beginning, if you look at Mankind, we have always been very focused company. Always worked on our own strengths rather than on weaknesses. For example, if you go for export and we don't have some entry barrier in our products, some patents, some difficult to make products, some complex product. So for one or 2 years, we can have some profits. That would be all tactical. The philosophy of Mankind is always long term. And that's one reason only 3% export is there. So we don't really see ourselves much in export. We'll always be in India-centric. If you look at Mankind, we are a 27 years old company. We launched Delhi in 2004. We launched Mumbai side 20 years back. So we have slowly and gradually evolved. Philosophy of mankind has always been not going and covering the market, going in a market and making a mark is our basically philosophy. So once we go in any place, whether it's a consumer side, look at our consumer division. Manforce condom, number one. Not only number one, it commands 30% market share. Look at Praga News, again number one, pregnancy cards for the ladies. Again, 80% market share, unwanted 72 emergency contraceptive pills. Sure. Again, 60% plus. Thought is always some kind of a leadership should be there.
Just on that point, consumer healthcare is probably another segment which a lot of people are interested in. It's only around 8 to 10% of your total sales. What is the kind of growth trajectory and investments that we can see in that space?
We are binded by this regulatory, so I'll just not go in any kind of speculation. But we see, we have look at the past. We've always grown very good in consumer side, and we hope to do the same in future. Let's hope like that.
Okay. There has been an NLEM price revision which took place in September of last year. Has there been any significant impact on your pharmaceutical portfolio?
Look at these are the strengths of Mankind. Only 13% products of Mankind comes in NLEM, in comparison to the industry where it is 20%. We've always been working on our sound fundamentals. 75% products of Mankind are being manufactured in-house. That's the number one. So what's the advantage? We can give best of the quality at most affordable price and still earn money. That's one. In R&D side, 12 years back we started and could crack dihydrogesterone. That's another strength. So when you look at any boxes of a company, so R&D, we have done this. In consumer side, I've told you the story of Manforce, Praga News side. Feet on the ground, 15,000 plus people. Distribution, one of the biggest in India amongst pharma companies. Advantage basically is what? It helps our distributors keeping less stock so that it does not burden them. Sure. We are a very technology-enabled company, but we still believe that in brand building, in marketing.
Margins slipped to 22% as of 9 months, which compares to 28% in the previous year. Why is that? And I know you can't give forward-looking statements, but has there been any stability?
See, this API prices were increased due to this China was locked down, some war was there, all these reasons were there. So as a whole industry felt the impact of that. Hope now they are a bit better and no forward speculation. We hope for the best. We hope things will be much better.
Okay, so the IPO opens next week. It's going to command a market cap of over 40,000 crores. So that is going to be a big IPO to watch out for. And just to put it into perspective, this particular IPO has already, or the particular company has already seen a revenue growth of around 15%. The issue size is 4,110 crores. It's a pure OFS of around 10%. So there will be 2 PEs which will be selling some amount of stake, as well as the promoters which will be selling around 2.5% stake. The company has indicated they do not need any kind of funds from the market, and that is because they are a zero debt company which has been generating cash. So those are the details to watch out for with regards to Mankind Pharma. Another piece of update was Fortis, which is going to be buying a hospital in Manesar for over 200 odd crores. So that particular company should come up for you. Remember, there's been so much interest in the entire hospital space simply because of medical tourism, as well as increasing occupancies because of higher insurance penetration post-COVID-19. So a lot of companies want to increase their capacity in different geographies as well. That could be in line with their strategy. Need to take a short break. We'll put the focus on what to expect from HCL Tech and Cyient ahead of their earnings later today. Welcome back. Well, slipped into the red currently for the Nifty, so just about consolidating. That's the name of the game. For the advance decline ratio, it's currently standing a little bit on the advances side, so it's favoring the advances. 1,900 stocks advancing on the Bombay Stock Exchange and 1,471 stocks which are declining at this point in time. The gap, however, seems to be narrowing at this point. But let's focus on the big Q today, which will be IT major HCL Tech, which will be reporting its Q4 numbers later this evening. Rima is here to tell us what we can expect. Rima.
Thanks so much for that. So from HCL Tech, the expectation is that it could be a modest set of numbers, right? Infi TCS have already reported numbers. The numbers have not been very good. So can HCL Tech be very different? So the expectations are fairly temperate. Dollar revenue growth of 0.2%, constant currency revenue decline of 1 to 1.5%. And the key reason for the decline is that last quarter, their products business, the software business, which is about 30% of their revenue, had a blowout quarter. Very strong revenue growth. That can't sustain. So that, revenue growth in the products business will normalize, come down, and it will put pressure on their quarter-on-quarter numbers. Margins, according to our poll, are seen lower by 120 basis points, largely due to the decline in their products business, and this will put pressure on the company's bottom line, seen down close to about 5%. The key is going to be their FY24 guidance. Remember, Infi came out with a guidance of 4 to 7%. For HCL Tech, we're looking at a guidance of between 5 to 7%. This is for the overall numbers. Watch for the services business. And again, margin commentary is going to be very critical because the supply side situation is easing. So therefore, there is scope for the companies to improve their margins in FY24 versus FY23. But does it reflect in the margin guidance? That's something that the street will be tracking very closely. Remember, the stock has already fallen 5% from the beginning of the earnings season. So the street is anyway going into the numbers a bit subdued, expecting a bit of a modest quarter this time.
Okay, and what about Cyient? Cyient will also be reporting its Q4 numbers. Rima, anything to expect from that stock?
Thanks so much for that. So from Cyient, we're actually expecting a pretty good quarter. A dollar revenue growth of 6.7% quarter on quarter. The company did say in the Q3 conference call that Q4 organic revenue growth in constant currency will be higher than Q3. And this will be driven by a pickup in automotive, aerospace and mining. Margins are seen higher by 20 basis points, driving a modest 3-4% increase in the profitability. The key focus is going to be on commentary surrounding demand and FY24 guidance. The company had guided for revenues to hit a $1 billion revenue run rate next year and an EPS of 60 rupees. Also keep your eye on any update from the design-led manufacturing, the DLM business, because the company has proposed an IPO for that.
All right, so that is about Cyient, but Tata Motors, Sonia, they have put serious money behind their electric vehicles business.
Absolutely. So, they're doubling down on their electric vehicles business, and that's the reason why the stock is one of the big movers today. In fact, the stock is up 20% this year already, so it's put in a good amount of work in the last couple of months. Now, let me tell you their plans. Jaguar Land Rover is looking to invest £15 billion in the electric vehicle business over the next 5 years. With that investment, they will be launching 3 electric vehicles over the next 2 years, and will be out of which there will be a new electric Range Rover that launches this year. And there's a mid-sized all-electric, SUV in this Range Rover series that will be launched in 2025. So the plans are quite aggressive. They've also guided for double-digit EBIT margins by FY26. This is in line with their earlier guidance. What they've done is pushed back their guidance on positive free cash flow. So now they're saying that they will, reach a net cash positive balance by FY25. Earlier, the plan was to reach it by FY24, but I guess because of this aggressive, investment of £15 billion, they've pushed it ahead by a year. Remember, currently, JLR has a net debt of around £3.8 billion. So, they will perhaps face a little bit of pressure because of this aggressive investment. Now, a lot of brokerages are very positive on the stock. Macquarie remains constructive. They say that there's a strong order book that JLR has and the supply side issues also resolving. Morgan Stanley has a target price of 513. And they maintain their overweight on the stock as well. But just a little bit of caution over here. Remember, at a time when Tesla is cutting prices of its electric vehicles, one wonders, and that's of course because of aggressive competition, one wonders how Tata Motors and the likes could, survive at a time when there's so much competition kicking in and the larger players like Tesla are cutting EV prices. So that seems to be just a bit of on a cautionary note. But otherwise, the stock is doing pretty well. Let's take a quick break. On the other side, Manisha Gupta is joining in. She has with her Kishore Narne of Motilal Oswal Commodity Brokers. Stay tuned.
Welcome back, and joining us now on the show is Kishore Narne. He's head of commodities and currencies with Motilal Oswal. Kishore, hi. A pleasure to have you on the show. I want to start talking about the crude oil prices first, where we have seen nearly 2% of a decline overnight, down by 4% in last 1 week. But on a monthly basis, we still are 12% on the higher side. So clearly, there is various fundamentals working right now. While supply doesn't seem as much as a concern, demand clearly is. And what are you reading in those numbers?
Good morning, Manisha. I think, see, as you mentioned, that crude has got a spike after the production cut, and then from there onwards, it is looking for fresh triggers on the upside. So there are a couple of data points which are very interesting, especially the Chinese growth numbers. U.S. hawkish data on the broader economy actually are positive factors for the demand. But also EIA report came up that the demand will be much better in the coming year. But at the same time, Russian oil continued to flow into the markets, which is actually keeping a lid on the prices. Second is the rate hike expectations of the Fed actually has jumped up in the last couple of weeks, which actually the markets were expecting a pause. Now I think a large amount of market is discounting a 25 basis point rate hike, and possibly there is a doubt or significant inclination of the market towards another rate hike in 2023. So that is actually keeping dollar buoyant in the markets, and that's actually keeping most of the prices of commodities lower. So which actually is the recent the last couple of days, especially the crude correction has actually been triggered by the strong dollar. So looking at the current market, probably I would like to say that it would be a range-bound market with not much of a price expectations. Probably the market will wait for the Fed to come out and say what is their stance. But till that time, the typical expectation for WTI would be 77, 78 on the lower side and 82, 82 and a half on the higher side.
Okay. How are you also looking at the natural gas prices now? Because the whole of winters passed away and we did not see the prices perform at all. And now as we are hitting the warm season, do you think the driving season, the air conditioning demand, the fact that we are looking at above normal temperatures, all of that looking to support price?
Yeah, so on the gas front, actually, there's not much of a buoyancy coming up actually. So I think I'm looking at prices to correct further lower even from here. Again, Russian gas is still available and Russian gas is still filling up the markets. So I'm looking at $2.15, $2.16 on the global markets. So probably another 2.5% downside from here. It could be in the next week or so. So currently at this point of time, it could continue to fall down from here.
You know, the factors that you mentioned about rate hike is something that seems to be impacting the base metal prices also. Last week was okay. I mean, the first couple of days of this week also saw some buying, but the last couple of trading sessions have not been so great. And every uptick actually is getting sold into.
Yeah, actually, see, base metals have been fundamentally supported by lower inventories, especially the copper has been supported by the lower inventories and also stronger broader economic numbers from China. Actually, looking at 4.5 GDP growth last quarter, actually China has actually blasted out on the base metal demand. But at the same time, rate hike concerns and that the Fed will make sure that economy would slow down and the inflation numbers are also not coming down. So actually, that is actually putting a pull on the base metal prices. So at this point of time, yes, copper would look better even at current levels. So I would be looking at, if you are looking at a short-term call, probably copper is a better bet for markets. Anywhere close to 768, 770 is a good buy. So we'll look for dips to buy. On the upside, 788 or 790 is a possible targets. So, but what happens is, probably because of the rate hike concerns, the market might not move instantly, but definitely copper is a good bet to buy, especially backing on the lower inventories.
All right. And Akshaya Tritiya is round the corner, and this is a time people do some token buying, if not big buying. And the only downside to this time around in Akshaya Tritiya in India is that there is no wedding season surrounding it. So you wouldn't see that buying factoring in. But where the gold prices are, and the fact, Kishore, that last year on Akshaya Tritiya, prices were at 50,000 odd. Right now, they're at 60,000 odd. So in matter of 1 year, we've seen 10,000 rupees per 10 grams of gains in gold prices. It's been a good return in last 1 year. Would you be looking at a similar kind of return in the next 1 year?
Yeah, Manisha, I think 60,000 is what we are seeing on the price. But if you go to a jewelry store, if you add the 3% GST plus another 15-20% of making charges, probably you are actually paying 75,000 plus for any 10 gram jewelry piece which you are buying. So that's extraordinarily expensive for consumers. That's where actually we are hit by. The consumer footfalls are much lower at this point of time. So this time Akshaya Tritiya could be interesting. But as an investment demand, people will still buy, as you already mentioned, there will be token purchases, could be, but large purchases I'm not expecting. On the price front, I'm not bearish on gold. Probably 1980, 1970, that's another $20-30 could be the downside. But I think every dip has to be bought into. And this rally is not going to stop anytime soon. And probably only thing is if the rupee goes to again 83, 84, probably you'll have a much higher beta in Indian prices. So 66, 68,000 towards this year end is not really long shot.
Okay.
Okay, all right, Manisha. Thanks very much for bringing us all of those updates in the commodity space. With that, it's a wrap on Halftime Report. Business Lunch will take all the action forward.